Nike stock is down 62% from its high in 2021. The company really struggled in its latest earnings report. I'm going to dig through that, but I want to go through how this company is going to perform long term, because the narrative right now is that this is going to be a great brand. It's a great time to buy this, and the recovery is on the horizon for Nike. But there are long term trends that Nike is trying to fight that most big brands have not been able to get over. Just look through this history here and the long term performance for brands that you would think would be great investments. Anheuser-Busch, since 2007, has a negative return. This is not including dividends, but the stock has a negative return, getting absolutely demolished by the S&P 500. You might say that's just a Budweiser problem. It's not. The same thing extends to Molson Coors. This chart doesn't go back quite as far, but since 2015, Molson Coors has a negative return, again, not including dividends. That's just a beer problem, right? It's not. Kraft Heinz also getting destroyed by the market. Who would have thought that? Since 2015, a negative 41% return. The other one to bring here, General Mills. Again, you would think cereal, baked goods, all these are standard consumer staple products, but the stock has underperformed the market by a wide margin over the past decade. Why is that? The answer comes down to the loss of power from supply in the market. These are all big brand companies that rely on the power they have as huge suppliers, power they have over distributors, power they have over retailers, power they have to reach customers through advertising on television and radio. But the world has changed over the past decade. This is now a digital-first economy, and companies like On Holding, Hoka, and companies built for the current economic environment where demand is really in power, companies that can advertise on social media, who can reach customers directly through email marketing, who are built with that in mind. Their cost structure, the formation of the business is built with those things in mind. They are outperforming these legacy companies. Nike is no different. Nike is getting destroyed by On Holding and Hoka, which is owned by Deckers Outdoor. Today, I'm going to get to why this is going to continue for the foreseeable future. You can see that this looks like a value stock. Price to earnings multiple, just 22.5. Enterprise value to sales, just 2.1. Nike may end up being a value, but this looks more like a value trap because of the strategic position that Nike is in today. So I'm going to explain all of this. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Don't forget to subscribe here on YouTube, and of course, check out Asymmetric Investing. My newsletter is a link on the screen and a link in the show notes. And I want to thank the company that's making all of these charts today. That's FinChat. Check out finchat.io/ASYM. You can get FinChat Pro for free. And if you like what you see there, and I think you're going to, this is a program that I am in constantly researching investments, but you can get 15% off using that link. You can use their charting tools. They have a great screener. You can get transcripts, all the information from investor relations sites. And the best thing is they have key performance indicators or KPIs for hundreds of companies. So you can see what the most important metrics to watch, and you can see how those numbers are changing over time. This is a product that I use all the time. You're going to see a lot of charts from FinChat. These are very, very simple to make. So check that out, finchat.io/ASYM. They're going to give you a great discount, and you can try it for 2 weeks, completely risk-free. But let's get to exactly what we are learning from Nike. So let's start with the quarterly trends from Nike. You can see that in the most recent quarter that was announced last week, revenue was $11.3 billion and revenue was down 9.3% from a year ago. Now, we knew this was going to be a bad quarter. That's why there was a bunch of changes made with management. So expectations were pretty low, and that was a pretty easy bar for Nike to get over. But you can see with this chart, which is just all trailing 12-month numbers, that the trend has actually been terrible for over a year for Nike. And this follows decades of growth for the company. So what in the world is going on, and how did Nike lose its position of power in the market? This really comes down to the power that supply had in the market in the pre-internet economy. Think about the way that big box retailers came up and the way that brands reached customers. A company like Nike had a relationship with all kinds of sporting goods companies, other retailers where they could get their product out there. And then how did Nike build its brand? It built its brand through advertising, through endorsements from athletes, spent tens of millions of dollars, if not billions of dollars, especially with somebody like Michael Jordan, to really make that name. So you built your perception about Nike before you ever even went to the store. And then once you walked into a store, you said, oh, you know what? I recognize that shoe. That's something that Michael Jordan wears. Or I recognize that brand. I have an affinity to that brand. That gave Nike power over those retailers. They could dictate the terms. They could make sure that competitors stayed out of the store. They wanted to own that shelf space. This is the story that we see across the industry. All those companies that I started with earlier, Budweiser. Why is there only a handful of those big beer brands like Budweiser and Molson Coors? They owned the supply in the market. They owned that shelf space. And they could walk into a liquor store or into a bar and say, you know what, we want to take up this much space. And I see you have a new craft brew over there. We're going to actually pull our product, which customers are going to come to your store for, they have an affinity for. We're going to pull our product if you have those competing products. That was the power that they had in the market. This extends to all those food companies that I talked about earlier, Kraft Heinz, General Mills. You can go down the list of any of these big brand companies. You can even go to Procter and Gamble, which is another consumer staple company. Most of those companies have underperformed the market over the last decade or two because they were predicated on the idea that supply was the power point in the market. But that has changed with the internet. How does a company like Hoka or On Holdings reach their customers? They don't have massive sponsorships. What they do is they do individual advertising, direct response advertising on Instagram, on Facebook, on Twitter. They're trying to build out a brand based on what you are looking for. It's a completely different way to build your business. They started with that direct response advertising, and then they moved into wholesale markets, so into retailers like Dick's Sporting Goods. Once they start moving into Dick's Sporting Goods, who is losing market share? Who is losing shelf space? It's companies like Nike. So now you walk into Dick's Sporting Goods and you have a company that was built on advertising for TV and radio and big endorsements like Nike. And then you have a company where there has been individualized ads built specifically for you. I got an email from On Holdings this morning. They sent me shoes based on not only what I've purchased from them in the past, but also the kinds of things that I'm interacting with on the internet because they have all of that information. That's how they build their advertising. So it's not just a random shoe that they're sending me. It's actually something that I have searched for before. That's the kind of relationship and that's the kind of infrastructure that those newer companies are simply built on. So let's look at their financial performance compared to Nike. Is On Holdings suffering from the same things that Nike is? It's absolutely not. If you look at their long-term trends, the company's growing revenue at about 30% per year. But look at these quarterly numbers. Now, I pulled these in US dollar numbers, which is why there's a little bit of volatility. This is a Swiss company, so that means that they have to convert their money to Swiss francs, particularly on the balance sheet, but sort of complicates their numbers a little bit. But look at the revenue growth, 35.7% in the most recent quarter. So as Nike is having a ton of struggles in the market, On is taking market share. Same trend holds true for Hoka. I'll start with this chart, which shows the long-term trend for Hoka. The black column is Hoka's total brand revenue. Again, remember I said that there's wholesale revenue and then there's direct-to-consumer revenue. So Hoka generates more than half of its revenue from wholesale. That's going through traditional retailers, other retailers beyond Hoka itself. But a big percentage of revenue does come directly from consumers. This is a look at their quarterly numbers. Not quite the same growth that you see from On Holding, 23.7% growth in the most recent quarter for just the Hoka brand. But you can see that these two brands are just examples of brands that are reaching consumers in a completely different way than Nike. They're fundamentally built to do that. And they're growing in wholesale and taking wholesale market share from Nike. So I think Nike's suffering from the exact same things that all of these other big brands did. It's just on a delayed time frame. We saw a lot of that disruption happening in places like the beer business and the food business in the early 2010s. You started to see more small brands start to pop up. You saw those at retail. You saw those at big box retailers. You saw those at grocery stores. But Nike actually held up pretty well, in part because they had a lot of brand affinity over the course of decades. And this is something you're wearing on an everyday basis. It's not ketchup in your fridge. But that is now starting to erode, and other brands are taking market share. And I don't think this is going to change anytime soon. That doesn't mean that Nike's business is going to continue to decline at nearly double digit, but it does mean that I think the profitability and growth for Nike is going to be capped. And so unless you're getting Nike stock at a no-brainer price, and I don't think a $100 billion market cap for Nike is a no-brainer price, this is a company that I think is just going to struggle just like all of these other supply-driven competitors have. So hopefully that's a different way of thinking about the company than you've ever seen before. The other easy thing to do on FinChat is look up a comparison between these companies. This chart shows a comparison of Nike's footwear revenue, so their shoe revenue, compared to On's shoe revenue and the Hoka brand. You can see just how much smaller those two brands are, how much growth they have ahead of them if they're going to come anywhere close to Nike's shoe business. So I look at this and I see risk for Nike and opportunity for Hoka and On. And the price is right. Like I said before, 2.1 times sales for Nike. That's sort of the proxy to look at. What is On Holdings trading for? Remember, they're growing at 35% in the most recent quarter, 5.4 times sales. So a little over twice as expensive, but you get a company that's actually growing instead of a company that's shrinking. Deckers Outdoor is a little bit cheaper, 3.2 times sales. Not quite the same growth you get from On Holding, but still a much better company, I think, today than Nike. So this is the dynamic that we're seeing in the market. You have the upstarts and companies that are built structurally for the current economic environment. And you have the old guard in Nike that is losing market share and I think is just fundamentally not built to compete well in the future. And based on that last chart, the opportunity for On and Hoka to grow is absolutely tremendous long-term. So that's why those are the companies that I'm looking at. On Holdings is one that I own in the Asymmetric portfolio. And I am definitely not adding Nike despite the fact that it's fallen back so much, because I think structurally the company is very poorly positioned for the long term. But let me know what you think in the comment section below. Don't forget to subscribe to Asymmetric Investing here on YouTube. And also on my newsletters, a link on the screen and a link in the show notes. And of course, check out finchat.io/ASYM. It's one of those tools I think you have to have as an investor, because it makes it so easy to look up information that would take hours to look up yourself. Let me know what you think of the future of Nike in the comment section below. Thanks for watching. We'll see you here next time.